Cool. All right, everyone. Welcome to this training. In this training, we're going to talk about passive losses, right? We're going to talk about the limitation of passive losses, how passive losses work, really understanding passive losses. Because you have to understand, right? One of the ways that you can build wealth for yourself is by investing. And a lot of people and business owners and investors, right? People who want to build wealth, they invest in real estate. And when they invest in real estate for a few reasons, right? They want to have what's called a cash flow, right? Meaning that the real estate will generate cash flow for you. At the same time, it is going to generate what's called a paper loss. That means from all the depreciation that you take, it is going to generate that loss. But is that loss deductible? How can you make it deductible? What is its limitation? And that's exactly what we're going to cover in this training. So let me quickly share with you my screen, and then and we're gonna get going. Give me just 1 second. All right, cool. So can everybody see my screen, my notepad? Let me know in the chat, or whether you're on Facebook or you are on a live Zoom call. But so again, passive losses, right? We first of all have to understand there's really three types of incomes that we have, right? I think I spoke about it before, but I always like to mention it. We have three types of income. We have ordinary income, right? What I like to call earned income. This is what you do when you earn it. This is when you work for that income, right? This is what you do to produce this income, right? Then we have portfolio income, right? Well, portfolio, and forgive me, right? This could include, forgive me for my handwriting, this could include for dividends, interest, stock transactions, right? So forth, right? So let's just say securities, right? Securities. And then we have something that's called passive income, okay? Passive income, right? And that is mainly derived from real estate. If you own any real estate assets, okay? If you own any real estate assets, most likely you're deriving passive income from your real estate assets. Another source for passive income are the businesses in which you are not materially participating, okay? That is really important to understand, right? My handwriting is super terrible. But anyways, we've got passive income coming in from real estate, right? And businesses in which you are not materially participating. When you're not materially participating, that business is considered passive. Today, we're going to talk about passive, okay? So passive comes in two forms. You've got passive income and passive losses. Unfortunately, passive losses can only be deducted against passive income. So if you purchase real estate property for yourself, right? If you purchase real estate property, you're going to generate cash flow. But because real estate gives you a nice cushion for depreciation, including bonus depreciation, you might produce a big paper loss. That paper loss is considered a passive loss, okay? Passive loss. Now, we are assuming in this training that you are not a real estate professional. When I say a real estate professional, I'm going to keep it very simple, not going to go through all the rules, but basically, you're not spending more than 50% of your time in real estate activities, whether it's managing, brokeraging, construction, anything of that sort that fits into the real estate. You're not spending more than 50% of the time. You're spending it on your business, deriving what's called an earned income, right? Ordinary business. I run a tax and accounting firm, okay? I have an ordinary income. That means I earn ordinary income, I should say. More than 50% of my time is from that. So by definition, by default already, I will not be considered a real estate professional. So that's why any losses that I incur from my rental properties will automatically be considered passive losses, okay? And I have a limitation. I have a limitation on how much I can deduct those passive losses, just like you are. If more than 50% of your time is spent providing services under ordinary income, under earned income, so to speak, which has nothing to do with real estate, you're not considered a real estate professional, which in fact means that you cannot take passive losses when you have them. There are a couple scenarios where you can actually take passive losses, right? And it's called active participation, and your income is less than $150,000. which is really a rare case with real estate investors, right? So, for example, if you are married and filing a joint return, right? If you're married filing a joint return and your income together is less than $150,000, then you can take up to $25,000 in passive losses from your real estate against your income. Okay? So this right here, ladies and gentlemen, is a planning opportunity for you. Now, there are individuals who can be making $1 million, right? Let's say you're making $1 million in your business. Okay? We're going to tie it back right here. Is it possible? Of course, it's possible. We're all doing it every day, right? There are business owners doing it. But can you still show that you're making less than $150,000? You absolutely can. If you're properly using tax strategies and you're properly planning for your taxes, right, you can actually shelter this income in different types of entities, right, in different types of entities, and only show that you're personally making $150,000 or less to take a $25,000 deduction. But that loss that you have on those properties. Now, obviously, if you have a lot more properties and your passive loss is much higher, right, you will probably not be able to stay within the $150,000 income limit. Your lifestyle is different, right? Will probably require more money to be reported on your personal tax return, right? That's just one of the ways. But passive losses are limited to you right now. The question now becomes, what can I do to turn my non-deductible passive losses, right? Let's just non-deductible passive losses. What can I do today to deduct my non-deductible passive losses? There's few things. Number one, what I've seen based on my experience with my clients, right? Even though they do invest in real estate to produce paper loss while be cash flow positive, generally speaking, from my experience, right? Investing in commercial property could result in passive income, even after depreciation. It happens because sometimes you can get a freaking great deal on a commercial property and your rent roll will be so much higher, your cap rate on that will be really high, right? And it will produce passive income. Regardless what kind of depreciation you take, even if you do cost segregation, do bonus depreciation, all of that could be helpful in the first year. Second year, you might have a big net profit. That's great, right? Why is that great? Because if you have passive losses from your non-commercial properties, right? Non-commercial properties, and that will generate losses. Well, the reason I read it in green, because these losses will not be deductible against your passive income. That's one of the times when you can deduct your passive losses against your passive income. If you have a passive income from real estate activities, now don't get me wrong, not only commercial properties can produce passive income, right? Residential properties can also produce passive income, right? Apartment buildings can at some point after depreciation is used up, produce passive income. Okay? And that passive income can be used to offset passive losses. That's why you need a tax strategy, right? If you want to build wealth for yourself, you need to start with having a tax plan and having a strategy. Does that mean that you need to invest once a year into a real estate? What type of real estate? What kind of losses can I generate? What kind of depreciation can I take? What will my passive losses be? I don't want to give up my main business just so that I can invest in real estate. How do I make it work myself? That is where you need a tax strategy, and there where you need tax planning. Okay, now back to us. If you've got losses, can you take these losses against passive income? You can. Another way to do it is if you are a savvy investor and you're looking to invest not only into real estate, but you're also looking to invest in businesses. Okay? You started a partnership with your friends. You do not materially participate. When I say material participation, I'm going to use a very conservative approach here. I'm talking about less than 100 hours. You might hear that material participation means also 500 hours. I don't want to get into complications of 500 hours in this segment because when you combine few other businesses where you are between 100 and 500, and it's 500 hours, it automatically gets aggregated as non-passive. So we're going to focus on when you investing in a business that you are participating less than 100 hours per year, right? Businesses. So let's say you start a partnership with friends. They're like, hey, Joe, we need some funding. We don't really need a lot from you. Maybe, I don't know, like maybe if you can take a look at the business, like 3 to 4 hours, check in, kind of do a couple of things, whatever that is. But we need the infusion of cash, right? You invested 20% equity. You're not materially participating. You're less than 100 hours, and you're not producing passive income, assuming that you want to invest in a business that actually produces income, right? You probably do not want to invest in a business that produces loss. Okay. So now that you're producing money, now that you're producing passive income, and you start investing in real estate, right? Let's just kind of draw a house here. Let's see. This is from my back in the day when I was bored in my classroom. I used to draw this, right? This is going to produce a loss for you. Well, guess what? This loss will be deductible. Okay. That's another way that you can deduct your loss, your passive loss. And again, just want to emphasize, right? You in this video, assuming that you are a business owner, okay? You have ordinary income. More than 50% of your time is being spent on your business that is not real estate. You do not qualify as a real estate professional, nor are you married, for example. Or if you are married, but your wife does also not qualify as a real estate professional. There is a lot of strategies actually that we can use where a married individual, while running a multi-million-dollar business, right? We actually have clients that are doing exactly this thing, running multi-million-dollar businesses, investing tons of money into real estate, but they cannot take those losses. Do they have passive business income? Passive income from other businesses? No. Do they make less than $150,000? No. Do they have other passive real estate activity that has income? No. So what do I do for those clients? Very simple. I use tax strategy and tax planning. I get the spouse involved. Look, what's your spouse doing? Spouse, well, my spouse is not working. Great. Can we have your spouse get involved in real estate so we can develop that real estate professional status where that passive income, passive losses are not turning into ordinary? Can we do that? Yes, we can. And that's another strategy, right? We'll probably do a segment on that later on. But you have to understand, right? Without proper tax planning, using tax strategies, all of this is just basic terminology. Passive loss has limitations. Tax code has limitations, but to your advantage, right? You have to understand that. Tax code is not made in a way to hurt you. It's actually incentivized. You just have to know how to use it. Passive losses, a lot of people look at passive loss as a huge limitation. It is, because IRS, what happened was that, I think it was before 1986, people were using passive losses, real estate losses, to offset their income. Just a little history background for you. Let's say you've got a doctor who makes, on a W-2, $500,000. And that's exactly what used to happen. I think this was before Ronald Reagan. I think Ronald Reagan is the one who instituted the whole passive loss limitation. I have to take a look at that. But in our scenario, a doctor is making $500,000, right? This is before passive loss limitation. Just to give you a little bit of history, $500,000, he pays a lot of taxes on it, right? So assuming he's paying 30% tax on it, they're just being generous, meaning he lives in, assuming he lives in Florida and Texas, no state income tax, right? He's going to end up paying $150,000 in taxes, right? So the doctor is thinking, how can I do to reduce his taxes? So the doctor goes out and invests in a property, right? That's what used to be back in the day, right? I invest in a property. I buy the property for, what color we're going to make this? $500,000. Okay, I buy the property for $500,000. The doctor only puts $100,000 of his own cash, assuming, right, 20% down payment. The beauty of debt, right? This is how the wealthy get rich in America, by the way. They use debt. Okay, and another way the wealthy get rich in America is they reduce their taxes. Two things: taxes and debt. Okay, think about that. Don't take my word for it. Look it up. But anyways, the doctor then takes the $500,000. The doctor takes a $500,000 property, buys this property. Watch this. He gets approximately, this doctor in the first year, approximately, he's going to get $150,000 deduction on his depreciation, right? Minus all the expenses that already wiped out the rent roll, okay? $150,000 deduction, okay? 30% on that, what is it 30% is going to give us? It's going to give us $45,000 in tax savings, right? The doctor is going to take this $145,000 in tax savings against his liability. So he's no longer paying $105,000, he's paying $105,000. And this is just the most mild scenario, right? And this is what used to be happening with real estate. And that's why we've got the Section 469 and the real estate professional regulations and rules come in. Because a lot of people were using it, and it was an amazing strategy, and it still is. It might have its limitations, but if you properly tax plan for this, right, you can make passive losses work for you. All right, I hope this was helpful. Let me know if you guys have any questions. Drop the comments below. Thanks so much.